All right, you're about to dive into a conversation between my friend Bill Clerico and I. Bill is the founder of Convective Ventures. I think most well known these days for being the wildfire VC, though Convective does more than just that around the forestry and outdoor land space. But prior to being the wildfire VC, Bill was also the founder of WePay, an early payments processing platform. I think there's been a lot of discussion lately about the divergence in valuation between Stripe and Adyen. I put out a bit of a question on how large the premium should be and should it be just attributed to the Collisons? And Bill quickly jumped in with a large yes. And so I invited him to jump on, have a conversation, roll cameras, and see exactly why he thinks the Collisons deserve such a premium after competing with them.
Every time Stripe comes out with new numbers, everyone loves to quickly do the math and go, but this is a comp for Adyen and it trades at 2x the premium, right? And the numbers actually are like growth numbers, margins. Some things are different, but they're not wildly different. I think the debate was how much of a founder premium should Stripe carry? And you immediately were like, a lot. So I don't know. You can run any direction you want with it. I'm super curious. Like you obviously been in the space. I mean, maybe a little background so everyone knows you're not just shooting darts from a very weak surface, a weak base like me, and actually come from some real place on this, and then give me your thoughts.
So I started a company called WePay back in 2008. We were a payments company. And so started at the same time. We were in the same Y Combinator batch. I have red hair as well as Patrick. So from a baseline, sort of comparable starting place, to watch someone so far out execute you over the next, 15 years is quite humbling. And so, I think I have to make the case that they're some of the best founders of all time because they're absolutely the ceiling on my ability as a founder. But I got front row seat of just seeing them start that company, and they had, a very simple insight, which was just that setting up a merchant account or a payment account was just far too hard. And there was this explosion of new business models on the internet coming, and they were just going to put those two things together and relentlessly execute around it. And I remember at the time sort of thinking like, that's not nearly complex enough to build a big company around. And I had, my whole strategy, which was far more complex. And that sort of simple insight coupled with like relentless execution, I think has built a behemoth. And I think like or behemoth, I guess maybe is the right pronunciation of that. But fast forwards, I think they maintain some of that simplicity and drive and just like sheer ambition. We get into the nuances of like the difference in product strategies and why I think Stripe is worth a lot more. But that like simple focus coupled with relentless execution, I think is a really powerful thing. And
there's two parts of this argument. It's like, hey, well, they're actually set up for way more explosive, interesting growth, interesting margins than Adyen. And so like, unpack the difference. And then there's these guys are just good capital allocators. They're better with the money than anyone else. So like, give it to them with a premium, right? Like, where is it between those two? Is it? I mean, it's obviously both in some degree. So maybe unpack those two different levers of premium.
Yeah. So before I started WePay, I spent 1 year as an investment banker. So thinking back to like training the street and my, training class, what is present value? It's future value discounted by the cost of capital and the risk, to present day. And I think like, when you think about sort of Stripe versus Adyen, one, the market reflects a different expectation of future value. And that's probably the biggest driver. And then I think there also is sort of a risk adjustment there too. And I think the founder premium sort of plays across both. In my opinion, Stripe is not just a payments company. I think they are gunning to be the commerce layer of everything. Moving money is one part of that, but it's inventory, it's reporting, it could be marketing, it's risk and fraud. And they are building this ecosystem around that using money flow as like the core plumbing, but they're going to extract all the value around that. Whereas I think Adyen aims to be a really good enterprise payment processor. And I think the difference in those businesses is potentially $1 trillion or more of sort of terminal state market value. And so like I look at, I sold my business to JP Morgan. And JP Morgan is the largest payment processor, or was the largest payment processor at the time. They have a great payment processing business. It's efficiently run. It's relatively high margin. It's huge. It's not worth that much relative to being the commerce layer of everything,
Maybe unpack that. Why isn't it worth that much?
It's just like payments by itself is not that great of a business. You have to move enormous amounts of money, take enormous amount of risk, deliver a ton of operational excellence. The large money flows from big clients end up being like incredibly thin margin, and it's essentially a commodity. And so we would have really big clients at JP Morgan where they would sit down with us once a quarter and they would score us, and they would say like, here was your uptime, here was your client service, here was your authorization rate, here was your cost. And they would benchmark us against another vendor that they would have. And based on who did slightly better on that scorecard in a given quarter, they would like shift volume between us and sort of get us to sort of perform. That was just how commoditized we were. And so like that drives margins like way down. And it's hard unless you have some sort of structural advantage. And so I think the brilliance of Stripe is like, yes, they're in the payments business, but they're adding all this other stuff on top. And once you build into all that other stuff, like you can't swap out the payments. You're sort of on their stack, and so they can defend that margin much more intensely than like an Adyen can, where they get swapped out.
Isn't there a whole
It's like kind of Rackspace versus AWS. I think it's maybe a comp, or DigitalOcean versus AWS.
Interesting. And then you just kind of wave the white. There's some portion of the ecosystem that wants to build their own stack, right? Maybe that's the beauty of AWS. Is a lot of people out of the gate are like, yeah, small companies are going to use this, but nobody big, right, is going to go on top of Amazon stack. And it turns out they did. Is that a fair short term? You're going to lose some big dogs, and then they're going to come back.
Yeah, I mean, I think the really large companies that have built their own stacks, most of them did it before Stripe existed. It's sort of like, it was built that way because it had to be built that way. But it's just really, if you're a capital allocator at a large tech company, are you going to go invest, tens of millions of dollars of engineering time and build your own payment stack? Or are you going to buy that on a marginal basis from a payment processor? Not that there isn't a case to make it yourself, but it's like very hard to prioritize that spend there versus on like something that really differentiates you. And I think that's sort of the brilliance of it, is that they're able to build that full stack and then amortize it across a bunch of different clients and deliver a far better stack at probably a lower marginal cost.
So to put a pin on this one, like how much of the premium do you think is from strategic moves they've made to date versus fuck, these guys are just smarter than everyone? How much of it is it manager selection versus chess moves already made?
Yeah, that's a good question. I mean, I think it's both. I think the strategy is required conviction. It was actually like quite expensive to build that whole stack. It was a big bet that people would move to that model in an industry where lots of people were selling it on a standalone basis. It was the right strategy, I think, because of the right founders that were able to sort of take that vision. And by the way, I think that continues to compound. Like they're doing stuff today that is going to pay off long in the future. Like I don't want to disclose anything that maybe isn't public, but like Stripe Billing is a monster of a product. It's probably one of the largest SaaS companies that's been built in the last 5 to 10 years on a standalone basis. And that's not even their core business. And so there are new seeds being planted today for those other adjacent businesses. Yep. So I don't know. I'm a fan.
Back to like founder archetypes, there's one of the things I miss, and I've been saying more these days, is like really special companies need people who can manipulate and maximize the markets. And there's 3 markets. There's matters. There's the market for your customers, the market for talent, and the market for capital. One, I literally just curious. This is something I just like, I don't know, put it that way 2 weeks ago, and now I'm in love with it, but it's my own bullshit.
Yeah, I love that.
I'm curious how you take on it. And then when you explain the Collisons back to me, I mean, I always say like Elon's core skill was bending the capital markets to do irrational things for him. You know what I mean? And now as you're explaining Stripe, it's like, you can put the Collisons in the same bucket, right? Where they like kept taking equity at prices that were pretty low cost of capital that weren't necessary to the core, but convince the markets and the board to let them make some real fundamental investment decisions that are paying off. I mean, is that, I don't know, one, is that a crazy lens I'm running with? And 2, are we putting Collisons in that bucket of founder?
Yeah, I think it's a great lens. And this concept of like momentum or market leadership, and like, what is that actually? I think it is an advantage that extends into those 3 markets, right? Like Stripe has a reputation for hiring amazing people and engineers, which creates this flywheel of more talent. They were very smart in taking capital at high prices, but they've also taken capital from basically every top venture firm in the Valley. And so you kind of box a bunch of other people out that, like no longer can take that capital, which is super smart. And then I think like with customers, that aura of like top tier venture dollars, great product strategy, great talent manifests itself in an amazing customer experience. And so it's just sort of like continues to feed itself.
It's funny just thinking out loud, like it continues with this trope I've had of needing hyper-capitalist founders. And like the fact that the Collison Twitch showed up at the Sohn conference, which is like the big heavy hitter hedge fund names conference, like the fact that they will make the time to run in those circles, I think is actually important and lost on a lot of Silicon Valley founders, that you need to speak a bunch of different languages and care about a bunch of different markets, including the capital markets. So I don't know that there's some great revelation other than it's hitting me over the head. You want founders who eventually want to show up at conferences like that, be able to get on stage and win toe to toe against the capital guys, in addition to being visionaries, product, customers, and recruiters.
I don't think that they think about Stripe as like a tech company they're building. I think they're thinking about a long-term financial institution that is in the business of sort of payments and commerce. And I think, 10, 15, 20 years from now, they'll be thinking about how to invest the balance sheet of that company in really interesting ways.
And I would say they're even there now. Like, our core insight was here. So like the edge for our capital, you know what I mean? It started with payments, and the edge for our capital is like concentric circles to that. And eventually over 20 years, it gets big enough you can do anything. That's interesting. Let's take that and extend it to like, you're doing more stuff that touches the real world.
Yeah.
What is your just hot take or takeaway or soundbite on what has become venture capital funding and financing norms running into your world of atoms and key lessons for founders?
I would hardware for like a very long time has been a bad word in venture capital, and so.
Which I think fairly, by the way, I'm on the camp of like, I think it's fair that it's a bad word. And that's not to say I don't love innovation, but it's a hard thing to do with early stage capital rationally, just on the facts.
Totally. I think that's more of a phase of the market than it is like a empirical truth. Silicon Valley started in silicon and hardware, and which is a very capital intensive business. And so I think that has been a product of, great innovation at the hardware level has unlocked all this great software, but that is increasingly commoditized and getting competitive. And, now it's pushing back into the real world, which needs to sort of catch up. And so I think the markets there are really hungry for better solutions. I think what holds hardware companies back is a lot of times what you don't want to be is in the, I call it the tractor selling business. You build a tractor, you sell a tractor. It's like low margin, one-time revenue, huge inventory costs, incredibly capital intensive. That's a pretty crummy business. I think what you want to be in is, can you deliver a high margin, recurring, high growth business? And if it's has proprietary hardware or sensors as part of it, that's great. And you may have a funding issue of it might be more capital intensive to build the building blocks of that. But if you're successful, you build an amazing business. And because of that, you're able to actually attract the capital to go do it. You want to be in that category, I think, as a hardware investor, not in the tractor selling business.
I'd actually push back on that. So here's my pushback.
Please. Yeah.
One is taking the old model, and now we're getting back to this, but for the last decade plus of hardware, you had two things working for you back in the day. One is there was a ton of intellectual property. The interesting part of the value creation was the hardware itself, right? You were out building novel semi-designs that if they were right, they were 10x faster, 10x cheaper. So all of the margin accrued to having something, you know what I mean? You didn't have to do anything after that. You got the hardware right and the value accrued to it. And I think we went through a long period where everyone would tell you I'm building hardware, but even founders would go, but the hardware is not interesting. It's the software that runs on it, right? But I need, and so we would talk internally and be like, all right, so this person needs $25 million just to then run the experiment on the software-based business model, right? Or I could just give money to somebody who on $3 million is going to test the software-based business model, right? And they both have similar end outcomes, if not. And so that's where I think a lot of the rationality came in of the trouble with hardware investing. Now, I think as we get to more of an era now where people are really, the novelty is in the hardware itself and building things that are not easily replicated by overseas manufacturers. The other I'd push on that I do think Silicon Valley, the tractor business isn't bad. The question is, what's the equity efficiency to get there, right? If you have to spend $1 billion in 3 years to do 20 million of free, that's bad. So I think that's just the nuance. I think as you get into, I don't know, you and I, one of our investments in common, I think people can laugh from the outside and be like, you're building sawmills, isn't that capital expensive? It's well, no, here's why our margins are pretty good. And oh, by the way, the payback to equity is awesome. And so I think that's just where Ian and I got onto the same page of you do need to think about some historical finance concepts if you're going to do this stuff, because it may be that the tractor business is great if there's actually a moment where venture makes a difference and you can build the equity value relative.
Yeah, and I think to your point, entry point and amount of equity you raise matters a ton, right? If you're raising at a multi-billion-dollar valuation, you have to see a real path to selling a lot of tractors in a high margin way and a recurring way. And not that it can't be done, but it's sort of that's harder than if you can find a way to find a 60 or 70% gross margin product that has a recurring business model, and maybe it's leasing those tractors or it's operating the tractors as a service. So there can be tweaks to the business model where proprietary hardware allows you to capture software margins.
Totally. And this is where I think you need to be a bit of a business model historian and like have some finance chops as you get into these businesses with atoms. And I think the last part too is like going in with the default assumption that you can hyperscale these. You know what I mean? When history has been like, man, most of these grow organically off of, you got to believe you can't hyperscale these until proven otherwise.
Yeah. Agreed.
Sweet.
Thanks for making it through all of that. As always, smash the subscribe button. I think that's what everybody says. And more importantly, let us know if you don't agree. We always love being disagreed with. You can follow me on Twitter at WQuist, Quist, or follow Slow. They retweet most of everything all of us say anyway. So at SLOW. And we'll see you next time.